All right. Good afternoon or evening, depending on which side of the country you're on, everyone. Go ahead and kick things off. My name is Thomas Wood. I'm the Director of Trading Operations here at MicroQuant. Today we're going to be talking about 3 key value bars patterns that are very, very effective in helping you identify some extremely low risk entry opportunities into these markets or into any market. So I'll show you one of them has to do with news releases, which is called the fair value snapback. And then we have a red matchstick and a yellow matchstick pattern, which are also pretty interesting value bars patterns that work fairly well for identifying turning points in markets and identifying entry opportunities in markets. So if you have any questions throughout the day, feel free to submit them via the GoToWebinar side menu at any time. And then at the end, we'll have a Q&A, and I'll go through and answer as many as I can. I want to make sure everybody understands everything before we close out the webinar at the end this afternoon. Now, before we really get started, just a really quick risk disclaimer. Trading or investing carries a high level of risk and is not suitable for all persons. Before deciding to trade or invest, you should carefully consider your investment objectives, level of experience, and ability to tolerate risk. This content is subject to change at any time without notice and is provided for the sole purpose of education and assistance in making independent investment decisions. ValueCharts.com has taken reasonable measures to ensure the accuracy of the information contained herein. However, ValueCharts.com does not guarantee its accuracy and is not liable for any loss or damage which may result directly or indirectly from such content or from an inability to access such information or any delay in or failure of the transmission or the receipt of any instruction or notification in connection therewith. Any past performance results are shown for illustration and example only, are hypothetical, and as such have many inherent limitations. No representation is being made that any account will or is likely to achieve profits or losses similar to those shown. Past performance is not necessarily indicative of future results. And then along those same lines, we have to cover CFTC Rule 4.41. Just a hypothetical disclaimer saying that all this has happened in the past, obviously. So we're showing you for illustration purposes only. It's not guaranteeing that you're going to make money equal to what we're showing. So what are value bars? Before we start talking about key value bar patterns, you really need to know what are value bars. Now, what value charts are, all value bars are, is they're a way to identify the 5 value levels from value charts much easier while simultaneously looking at price movement. Now, value charts plot price in one of 5 color-coded valuation zones. The center green area is fair value. Above and below that, we have this upper yellow and lower yellow area, which is moderately overvalued and moderately undervalued. And then above and below that, we have significantly over and significantly undervalued. Now, roughly 66% of all trading activity takes place in this fair value zone, with about 16% of all trading activity taking place in moderately over or moderately undervalued. And then just about 2.5% of all trading activity takes place in the significantly overvalued or significantly undervalued price zones, respectively. Now, the way that value bars work, historically, all we've ever looked at is a price chart. Well, there's 3 things you need to be analyzing in order to decide to enter into any trade, in my opinion, and that's cost, momentum, and value. And what we have done is we've superimposed the value chart over top of your traditional price chart so you can see them both, the price or the cost and the value at the same time simultaneously. So you can see here significantly undervalued on your value chart corresponds to the lower red bar segment on your value bar. Moderately undervalued corresponds to the lower yellow bar segments on your value bar. Center is fair value or green on a value bar. Upper yellow is moderately overvalued. And then upper red is significantly overvalued according to value charts. All right, so that's just a really quick, brief explanation of what value charts and value bars are and how they can help you. And this is how we're going to be using them. Now, what are the 3 value bar patterns that we're going to be discussing? The first one is called the fair value snapback. This only works during news releases, so don't try doing it when there's not a release. You need to do it when there is a high volatility release news announcement coming up, like FOMC or the Bernanke's talking or something that's going to cause a large price move, maybe a crop report or a petroleum status report. You only want to trade it there. The way that a fair value snapback works is you're looking at either a 60, a 120, or a 240-minute chart. They occur on all the different time frames. What happens is the market will drop down into undervalued. So let's say it gets undervalued right there, and then it will turn and bounce right back up into fair value right here. As soon as it crosses up into fair value, you're getting long with your stop down below the low, and then you're trying to catch that snapback. It's like a rubber band. When you pull a rubber band one direction and then let it go, it snaps back really quick in the opposite direction. That's similar to how the fair value snapback works, and I'll show you a couple examples on charts here in just a moment. You also have the yellow matchstick. Okay, the yellow matchstick is a reversal pattern. It's traded during a new high or a new low, when a new high or a new low is reached. And what you're looking for is for the price to, if there's your first high, you're looking for your price to barely peak above the previous high, get all the way up into moderately overvalued, and then come back down and close in fair value below the previous high. When that happens, you get short, your stop goes just above the high, and you're looking for that market to turn around and sell off, or the opposite direction if you're trying to go long, if you're looking for hitting new lows. Now the red matchstick is about the exact same thing as a yellow matchstick, except instead of hitting new highs and going moderately overvalued and then closing in fair value, you're hitting new highs going significantly over or undervalued and then closing in moderately over or undervalued. So you're going to one extreme and then closing in one level below that, if you think of it in three different levels: fair value, moderately over under, and significantly over under. So any questions on what they are before we start looking at some examples? I only have a few examples, and I'll try to explain them in as much detail as I can so you understand how they work. The first one we're going to look at is the fair value snapback. This is what this looks like. Okay, you have your news announcement. You can see this market. This is gold, by the way, and this was on September 13th. By the way, this happens. There's a lot more of these that have taken place since then. This is just an example I had already. So this is gold on September 13th, 2012, if you want to take a look at it, so you can see what the price is. But you can see what happened here. You had the news announcement, price sold off all the way down into moderately undervalued, and then it turned around back up into fair value here. So remember, the buy signal occurs as soon as the price snaps back from undervalued to fair value. So right at this line here. As soon as it snaps back, you're getting long with your stop down below the low. And then you're looking to exit at the opposing value level or opposing extreme value level. So in this case here, you're looking to risk about $4 an ounce in gold, and you're taking profits at plus $30 an ounce. Pretty fairly decent size reward risk ratio, if you ask me. I wouldn't mind doing that every day. Now again, the fair value snapback only happens on news announcements. So you don't want to just look at a price bar, see it go up and overvalued, then come back down to fair value and then go short. That's not how it works. It needs to be during a news release, because it's like what's going on is the market has that knee-jerk reaction and then saying, oh, wait a second, that's the wrong way, and turns around and jumps the opposite direction. Okay, so again, you're entering your buy signal is on the snapback from undervalued to fair value. Your stop is placed at the low. Your exit is moderately overvalued or significantly overvalued. You can also do it in the exact opposite direction. If you just picture this chart turned upside down, so you're going up overvalued and then snapping back down into fair value, you're going short. Your profit targets are moderately undervalued and significantly undervalued. Now, if it's a true fair value snapback, this move right here should only take a few minutes. It should not take very long at all for that market to really take off. And once it breaks back into fair value, it should never go back down to the low. All right, and I'll show you. This is what this exact same time frame. This is on a 2-minute chart, though. Okay, so here's a 2-minute chart of this fair value snapback. And this dotted line, it's actually a little bit high. You can see the fair value and undervalued line right here is at 1732.80. This is at 1733. Okay, so it's actually a little bit lower than here is where that should be. So you sell off, you bounce back up into fair value, you get long right here, your stop is at the low. You see you have 2, 4, 6, 8, 10, 12, 14 minutes, and then you're up $20 an ounce, which is $2,000 a contract. You're entering based off of a 60, a 120, or a 240-minute chart. That's what I personally like to use. I know Mark occasionally will use a 30-minute chart. It's a little bit too reactive in my opinion though. 60 is actually a little bit too reactive for me too. The only time I ever really trade these is when I see it on a 240-minute chart. That's my favorite one. It typically, when they happen, they work the best in my opinion. So I like using 240-minute charts. And again, you can see once it popped back up into fair value, it really didn't go anywhere. And if you actually look here, this is at 12:30 when the announcement took place, okay? That price bar. So really, this was a snapback, this bar right here. So it really should have only taken you about 4 minutes to get up to $20 an ounce, because the news announcement took place, hit undervalued, and then snapped straight back up. And remember, this dotted line here is where undervalued was, or is where undervalued is on your 60-minute chart. 1732.86 or 1732.80 because it's gold, and then this is at 1733, so this is about 20 cents too high, 2 ticks. So it really should have been right here. It hit undervalued and immediately snapped straight back up. That's what you want to see. You do not want to see it bounce around in undervalued. So you don't want to see it drop and then just stay down here like this. You don't want to see it go like this. You want to see it drop, hit undervalued, and ricochet just like a rubber band. Please explain why I'm showing a 2-minute chart and how you use a 240-minute chart. The 240-minute chart is used to determine where undervalued and overvalued are, where the fair value snapback is. Okay, if you think about it this way, this is a 60-minute chart. So this is a 60-minute fair value snapback. You drop undervalued and then snap straight back up. If you think about it, inside a 60-minute bar, there's 32-minute bars. Okay, so even though this bar just looks like one giant move up like that, the market actually did this inside that bar. Okay, so I'm just drilling down to show you what actually, the price action that actually occurred from that announcement, how it really in one single 2-minute bar dropped down undervalued, snapped it all the way back up, and shot straight through the roof. If that makes sense. Does that answer your question, Wynn? So I'm just trying to show you what the price action actually looks like on a shorter time frame when the announcement takes place. This should be a very, very fast trade and very low risk. All right, that's the fair value snapback. Now we're going to talk about what we call a yellow matchstick. Remember, with the yellow matchstick pattern, you're looking for a reversal from new highs or from new lows. Remember, what you're looking for to happen is the market to break the previous high. So if here's high number 1, you're looking for your second high to break the high, come back, and close below that first high. And you want to see it go overvalued at the top and then close in fair value, just like this. So here's this high, okay? You broke up to new highs, you went overvalued as signified by the upper yellow bar segment. You went moderately overvalued, broke the previous highs, closed back down in fair value, which is green, and then immediately turned around and sold right back off. What that's telling you, what that price action is telling you, is that the buyers came in, knocked out all the stops, and then immediately turned around and shot straight back down and reversed it. And you'll find markets do this all the time. They'll run stops, they'll knock out the stops, and then turn around and go. They don't want to just give it away for free. When this sort of thing happens, where you break the high, you go all the way up overvalued, close back in fair value, that is textbook trade, and your reward risk ratio is typically extremely high on this. You're talking 10, 15, 20 to 1 reward risk ratio, where you're risking $100 and you're making 1,000, or you're making 2,000. Excuse me. So you can see here, popped up overvalued, broke the high, came back down, closed in fair value. So what you do is you short on the open of the very next bar with your stop just above this high here. And when I say just above the high, I mean 2 to 3 ticks above the high. You're not risking very much. And then you want to see the very next bar turn and sell off. And you can see this sold straight off. Now your first profit target is undervalued or significantly undervalued, just like the fair value snapback. Now, if you have a significant reason to believe prices are going to move even further, then there's nothing that says you have to get out at undervalued or have to get out at a value target. You can hold the price, or you can hold that position longer if you believe prices are going to continue to fall. This is soybeans on a daily chart. It'll work on any time frame though. You don't have to just trade it on a daily. The one thing you need to keep in mind though, depending on the time frame you're trading, your profit targets are going to be reached much sooner. Okay, so you could have a yellow matchstick pattern on a 5-minute chart where you have high 1, high 2 breaks the high, closes back in fair value, and you're expecting it to sell off, but you're only expecting it to sell off for maybe 10-15 minutes if you're trading off of a 5-minute chart, whereas on a daily chart you're expecting it to sell off for 2, 3, 4 days if it occurs on a daily chart. Just like if you're trading on an hourly, then you expect to sell off 2, 3, 4 hours. Okay, keep in mind, depending on the time frame you're trading, that's where your profit targets are going to be taken. So if you're trading off of a daily chart, you're looking at daily profit targets. If you're trading off of a 5-minute chart, you're looking at intraday profit targets, 5-minute profit targets. If you're trading off a 240-minute chart, maybe a day or two, depending on how long you want to hold it. So keep that in mind. Your profit targets are determined based off of the time frame that you're trading, based off of the setup, which time frame you saw this, identified the setup on. Now again, the stop loss gets placed the exact same no matter what time frame you're on. So on a daily chart, you're going to be risking a little bit more than what you would if you were trading off a 5-minute chart, because obviously in one day, this distance on a daily bar could be 2 or 3 points, where that distance on a time-based bar or on a 5-minute bar might be a half a point. Okay, so keep that in mind. Your risk is going to be more for dailies, but then again, your reward's also going to be bigger. What I typically will do, I'll still trade the daily setups, except I'll downsize my position. So if I typically trade 5 to 10 contracts, I'll trade 2 to 5 contracts if I'm trading on a daily. What I try to do with my position sizing, you have a couple different options when trading. You need to make sure you're adjusting your position sizing based on the markets you're trading, or based on the amount of risk that you're allowing yourself. I personally, depending on the account I'm trading on, have a set amount that I'm willing to risk per trade. Now, if I can trade 15 contracts and put my stop where it needs to go and still risk that amount, then I'll trade 15 contracts. If I can only trade 2 contracts and then I have and put my stop where it has to go and it hits my max, then I'll only risk 2 contracts. That's position sizing based on risk. It keeps all of your losses the same. The other option is volatility adjusting. And there's a couple different ways you can do that, but you're essentially looking at the volatility, the daily volatility of any given market, and then you're adjusting your position sizing based on the market volatility. So if you're trading a highly volatile market like gold, you may trade 2 contracts, where if you're trading something like the Dow, you'll trade 6 instead of trading 2. So there's a couple different ways I would encourage you to look into volatility adjusting and just adjusting your position sizing based on the markets you're trading. That's very important to trading. The reason that's important is because it keeps you from having one loss that wipes out all of your gains. So if you're not volatility adjusting, let's say you're just trading 2 contracts on everything. Well, you trade 2 contracts in gold and you have a loss, you might have a $500 loss. You trade 2 contracts in the Dow You have a gain, and it looks like a really nice gain. The problem is the Dow is a much smaller contract, and the volatility is much lower than that of gold. So even though you trade the same number of contracts, you still might be negative because your gain on the Dow is going to be lower than your gain in gold, or than your loss in gold, based on volatility and contract sizing. So just an extra nugget for you there. I would encourage you to look into volatility adjusting or position size adjusting based on contract size. Now, here's another example of a yellow matchstick. Okay, remember, you hit new highs. So here's this previous high here. You come all the way up, pop up, break this high just barely, come back, close in fair value. So you went moderately overvalued, broke the high, came right back down, closed in fair value. So you're going short with your stop just above the high, and immediately you can see this turn and sold right off, just like you want to see. This is soy, by the way, and this is on a 240-minute chart. Okay, the exact same setup. It's fairly simple setup. It's not that difficult to trade. You're looking for it, once again, break the previous high. So rule number 1 has to break the high. Rule number 2 has to get into over or undervalued, so it either breaks the high or breaks the low. Rule number 3, it closes back in fair value and closes back below the high or low, or above the low. So you're looking for it to close below this high here, or close above the low if it was a reversal to the upside. Again, that's called a yellow matchstick. Pretty simple concept. Any questions about that before I move on to the red matchstick? I want to make sure everybody understands everything. Again, it's pretty simple strategy. Break the high, go overvalued, come back, close in fair value underneath the high. All right, no questions? We'll go ahead and talk about a red matchstick. Red matchstick is the exact same thing essentially, except instead of going moderately overvalued and then closing in fair value, you're going significantly overvalued, as signified by the upper red bar segment, and then closing back in fair value. So you're going up. If you recall your value chart, you have your 5 value zones: fair value, moderately over and undervalued, significantly over and undervalued. With a red matchstick, you're looking for it to go significantly overvalued and then come back down to fair value, or significantly undervalued and come back into moderately undervalued. With the yellow matchstick, you're looking for it to go moderately overvalued and then fair value, or moderately undervalued and then fair value. So you can see here we popped all the way up, significantly overvalued, broke the previous high, came back, closed back in fair value, or in moderately overvalued, and then the very next bar you sold right off. And this is the euro on a daily contract, and this is still a fairly decent sized move. I mean, that's a drop from 1.32 all the way down the very next day, 1.305. So that's about 150 ticks, about $1,700 a contract. Pretty nice sized move there. All right, so red matchstick is the exact same thing essentially as a yellow matchstick, except it closes in moderately over or undervalued instead of fair value. Yellow matchstick. What is the maximum number of bars the rule allows between the first high and the second high? It really just depends. There's not a maximum number. Are you saying, why am I not counting this high back here? Sort of thing. Why am I not counting this high back here instead of this high? There's not a maximum number of bars back you're looking. The reason I'm counting this high here is because this is the daily high. You can see these dotted vertical lines, for those of you that are not familiar with TradeStation, these are the close of the day and the open of the new day. So that was the previous day daily high. So it broke the day's high and then dropped right back down and turned around. Oh, yes. I wouldn't necessarily say it breaks the high of 200 bars ago. You're really looking for one within, I would say, probably 20 bars or so. So if you're looking at the highs, basically this area here, You don't really want to be looking way back. If you're going way back like that and looking at a high that was 200 bars ago, then you're probably just looking at a resistance level. I wouldn't trade it this way necessarily. But then again, it is a very bullish or bearish sign when a resistance or support level or a trend line is broken and the market doesn't run, it bounces right back up. So if you have a trend line here, for example, come across these lows, a lot of times it's pretty bullish. Normally you want to see a market when it breaks a trend line, take off and run, okay? But when a market goes to a trend line, breaks through, and then pulls back up above it like this, a lot of times that's very bullish because it's saying the sellers should have been there to continue to push prices down. When they don't drop the prices like they should, a lot of times it's a bullish sign. It means the sellers just aren't there, and the buyers will come back and cause prices to rally back up once again, and you'll form a new trend line. Okay, am I referring to yellow and red matchsticks for all time frames during regular trading or news announcements only? Matchsticks are at any time. Okay, the yellow and the red matchstick patterns, they're at any time. The only one that's a news announcement is the fair value snapback. Okay, fair value snapbacks only done during high volatility news announcements like a crop report, FOMC, petroleum status report. I've traded a natural gas fair value snapback when you have the natural gas report on Thursdays. So it's an announcement that you expect to cause a large amount of volatility in the market. You do, with the matchsticks, you can trade them on essentially any time frame at any time during the day or night that you see them occur. They don't happen all that often, but when they do, all three of these ValueBars patterns are a lot of times very low risk opportunities for high reward. So you get a high reward risk ratio with a lot of these trade setups. You just have to be watching for them. So just keep your eyes open, keep an eye out for them, and watch them to occur. So any more questions about them, about those three different patterns? Fair value snapback, again, not that much information to cover tonight. I actually went very short, so I apologize for that. But there's three patterns. Again, you have fair value snapback, you have the yellow matchstick, and you have the red matchstick. Pretty simple. All right, if there's no more questions, that's all for today. Feel free to send in a request if you have any more questions that you think of later to support@microquant.com. Again, my name is Thomas Wood. If you want to learn more about the indicators, feel free to visit valuecharts.com. If you want to watch any of the recorded webinars from previous Tuesday night webinars, you can go to youtube.com/valuecharts, and there's a whole list of webinars there, all the previous Tuesday night webinars. Can you use these during the Globex hours? Yes, you can. Is there going to be a recording of this presentation available? Yes, there will be a recording. It'll get uploaded to YouTube by the end of the week. It should be up there. Yes, you can trade this during Globex hours, off-peak hours. Any other questions? If there's not, then I'll go ahead and conclude the webinar. Thank you everyone for coming. Hope you enjoy the rest of your evening.